So again, 50 questions, and we'll go over as quick as we can. First one is going to be inventory turnover ratio. Right? Inventory turnover ratio. How do we determine that? The inventory turnover ratio is cost of goods sold divided by average inventory. How do we determine average inventory? It's beginning inventory and ending inventory divided by 2. So cost of goods sold is 100. We say this is 10. This is 20. We can do this plus this divided by 2. Inventory turnover ratio is our cost of goods sold divided by our average inventory. That would be our inventory turnover ratio. You'll have some questions on inventory turnover ratio. So know this calculation and know how to do it. Understand it. Stop me if you have any questions. I'll be asking you to determine balances in the accounting equation. So I might say assets, liabilities, and equity. I might say accounts receivable is 100. Supplies are 100. Accounts payable is 100. What would your equity be? What would your equity be in this situation?
100.
Exactly, 100. We plug it, right? Good. Good. Let's make sure that's checked. So I'm going, these could be switched up. It could be, I need you to know your accounting equation. I need you to know your normal balances for all of your major line items on your financial statements. So that includes cash, accounts receivable, supplies, equipment, accounts payable, all of that, right? And then if I ask you if accounts receivable is an asset, liability, or equity, you need to be able to tell me it's an asset. And if I tell you it's a normal balance of a debit or a credit, you need to be able to tell me a debit. I've made a lot of videos on this, and we've talked about it a lot, so please practice this. That's going to be a few questions of just determining what the plug is. Plug. Why is that? Because assets equal liabilities plus equity. What is this? What is this accounting equation? What is this financial statement that ties the accounting equation?
Balance sheet.
Balance sheet, correct. Balance sheet. So know the flow of the accounting equations. Balance sheet. We have income statement. Income statement, statement of equity, or statement of retained earnings, balance sheet, and then statement of cash flows. Right? We need to know that flow. Make sure you're taking notes on all this while I go through it. These are all different questions. They're all going to be multiple choice, like A, B, C, D, E, and then you choose one of the answers. Next is, what is your days sales and inventory ratio? I might also ask you, how are these used? Like, what are they used for? We need to know our ending inventory, cost of goods sold. Ending inventory might be 100, cost of goods sold might be 1,000. Day sales and inventory is our ending inventory divided by our cost of goods sold divided by times 365. That tells us how quickly our inventory is on our shelf before we sell it. Right? So these are things we need to understand. Feel free to take notes on this or on your sheets, right? What is a journal entry? I'm going to be going over basic journal entries. All the journal entries we covered, they're our fair game for the test. But specifically, we're going to go from easy to hard. Things like, what is, if I tell you to do a journal entry for getting a telephone bill and paying for it immediately. what would that journal entry be?
So telephone expense and cash.
Good, yeah. You telephone. And is telephone expense a debit or a credit?
It's a debit.
Debit, good, because it's an expense. Perfect. So I can ask you that, and I could ask you which is the debit, which is the credit, and how much are the amounts. I'm going to ask you questions about perpetual LIFO. Oh, sorry. Let me show you. Okay. Perpetual LIFO. I'm not going to go over an example again. We did that enough. So go back to, so check your perpetual LIFO. Perpetual. But I'm going to ask, I could ask you anything in perpetual LIFO, right? I could ask you, what is your ending inventory value? What is your cost of sales? I could ask you to stop in the middle of a transaction and determine one of these pieces, or your costs of goods available for sale. All of that, right? These are all familiar, right? We've all gone through this. This is what we've been doing. So I'm not trying to surprise you with any of these questions. I hope you see that. A company has net sales of, let's see. Again, I told you I'm going to test you on ratios, right? Accounts receivable turnover ratio. Right, that's just our net sales divided by our average accounts receivable. So if we have 100, 200, 200, it would be a 1, right? And we know how to determine our average. What does the average accounts receivable turnover tell us? It tells us how quickly we collect our accounts receivable. I'm going to ask you to calculate the current ratio. All of our different ratios we talked about. Current ratio, asset ratio, all of those things. How do we do current ratio? It's current assets divided by current liabilities. 200. I'm going to ask you questions like, what's advantageous? Is it having a higher current ratio or lower? We know that anything above 1 is good, right? Above 1 means we can pay our current debts. This will also ask you what's included in current assets and current liabilities. So I'm not just going to say, here's $200 in current assets. I might say, here's investments, equipment, current assets, liabilities, notes. Determine which one of those are current assets and current liabilities, and then determine the current ratio. You need to be able to classify these. I'm going to ask you about, I can ask you about different financial statement line items and what financial statements they show up on. So let's go over a few right now. Financial. I might ask you, let's see, rent, expense, earnings, accounts receivable, and and then I can ask you, what financial statements do these show up on? Rent expense, what financial statement? Income statement, balance sheet, or statement of equity?
Income.
Income statement, right? Good. Retained earnings, where does it show up?
Equity.
Yes, statement of equity and balance sheet. Accounts receivable.
Balance sheet.
Yep, balance sheet. Changes in cash.
Statement of cash flows.
Yeah, they got it. And interest expense.
income statement.
There you go. So you need to know all of that. Just quick. That was great, Majaba. Everyone should know it that quickly for this exam. If you don't, make sure you go back and practice. And I've shared videos on all of that, especially those first few videos. We go over all the different types and where they fall. We'll go over journal entries for purchasing and returning goods. Also discounting, right? So what if I sold product, or what if I purchased product that had the 210 net 30? Remember we did all that? The 210 net 30, the discount, 2% discount in 10 days. Know how the journal entries. So. I'm going to ask you to be able to figure out plugs. So, for example, I had accounts receivable, and I said we had a beginning balance of 100, ending balance of 1,000, and we knew it increased. We had a sale of 200, and a collection of 300. What was the value of the other sales in the period? Right, and we could just do this plus this plus this. That's 0. So we know we had to have $1,000 in other sales, right? I'm going to ask you to be able to determine those balances, and if it's a debit or credit journal entry. I'm going to ask you, we talked about factoring, just knowing the concept of factoring, where if a finance company or bank purchases another company's receivables. I'm not going to ask you about any of the journal entries. I just want you to know what it is. It's not pledging, it's factoring. Yeah. I'm going to want you to go over your interest expense calculations, expense and interest revenue, and understanding like, hey, if we're doing 30 so interest expense and prorating it. Whenever we prorate, I want you to use a 30-day year. I mean a 360-day year or 30-day month for the calculations. I'm also going to go over accruals and deferrals. What is that? Like prepaid insurance, deferred rent, deferred revenue, etc. I also want you to know you're adjusting journal entries for these. Right. So at the end of a period, we determine how much has been used, and then we would do debit or credit out the remaining balance. Like, for example, prepaid rent, right? If we pay $1,200 in rent halfway through the year, we debit prepaid rent, credit cash, and then at the end of the year, we would debit rented expense and then credit prepaid rent for half that value. Okay. I'm going to be asking you about the concepts of FIFO and LIFO and average cost. So if I asked you, so I'll put all inventory costing methods. If I asked you here, what is your, what is the one that most accurately mimics the most flow of goods for most businesses? what would we say? Is it FIFO, LIFO, or average cost? Which is most accurately represents what most companies do?
FIFO?
Yeah, good job. Perfect. And what do most companies elect? Also FIFO. Good. I'm going to ask you about consignment, like consignees. I feel like someone's not muted. Let me make sure everyone's muted. Cool. So I'll ask you about consignment. So what is consignment, right? There's a consignor and a consignee. A consignor continues to own consigned goods, right? They always, the consignor, we give out our goods to the consignee, but we still own the goods for the consignor. Goods on consignment are provided by the owner, the owner is the consignor. A consignee sells goods to the owner. Sells good for the owner, right? The consignee is the one who's selling on behalf of the owner, but legal title never transfers, and the consignor reports its goods in its inventory, right? Consignor keeps the inventory on its books. The consignee doesn't keep the inventory. The consignee doesn't have the title. And then the consignee does not report the inventory. So like, just understand the theory. Minor. Maybe. I'm going to ask you to do bank reconciliations. Not a lot, maybe 1 or 2 questions. So I might ask you like adjusted cash balance or adjusted book balance. You're only going to have to answer one, right? It's going to be everything's multiple choice. So. Again, I'll continue to ask questions about how the accounting equation has changed, like we did on day 1, 2, 3 of, hey, if we use cash to purchase supplies, how does that change the accounting equation? Is there an impact? No, not if we use cash to purchase supplies. But if we use liabilities to purchase supplies, yes, there is. We increase liabilities and we increase our assets, right? So understand the accounting equation and our normal balances. Remember, debits equal credits, assets equal liabilities plus equity. I talked about this a lot, the theory of inventory counting. Inventory accounting. So the theory of inventory accounting, right? Including like manual counts of inventory. I talked about this a lot in class. We have perpetual systems, but we always do a physical inventory account because our systems don't always capture everything. We need to do a count at the end of every period in order to accurately account for inventory, no matter what. So there's always a physical inventory count. And remember the examples I told you about, even in audit, you do inventory accounts. And I used to do it for like steel beams and all these crazy things. The understatement of what happens if for error accounting, we talked about errors specifically related to inventory. I want you to we had a whole few slides on that and a few questions. So error adjustment. So for example, what happens if we understate inventory? We overstate, that overstates the cost of sales, and net income is understated, right? Or what if we overstated ending inventory, how it flips it? I'll ask you to be able to identify different accounts as assets, liabilities, equity. We talked about that. I'm going to ask you about the gross margin ratio. I'm not going to calculate it out for you. I mean, I'm giving you kind of more than enough, I think, as it is here. And I want you to know the difference between terminology, terms, the difference between an accounting equation, income statement, net income, business, monetary unit. Let's see. I want you to know the historical cost principle. What is that? That's how we should be recording our assets at the cost we paid for them. Right? So if I could tell you what it's worth today, what's its tax base, how much assets are on it, but at the end of the day, we care about what we paid, right? Historical cost principle. Again, interest. I'm going to be asking interest a few times to calculate the prorated interest. And I'm going to be asking you about the different allowance methods we talked about today. So accounts receivable, allowance methods, or we'll call it allowance for doubtful, ADA methods. What are the methods? We have direct write-off, percent of sales. We have our percent of accounts receivable and AR aging. We have our different, this is not GAAP. This is a percentage of credit sales. This is percentage of AR, and then this is buckets, right? So know all those different methods, know how to calculate them, and know their journal entries. Understand how to establish, what's the JE for establishing petty cash fund.
Just to point out on the AR aging, we're going to use the 360 days, right?
Yep, I want 360 just for this, just for your homework and stuff. And for the class. In real life, we use a 365, 366, but just use 360 for these questions. That's how the book is structured. Good question. Yeah, again, discounts. A lot of these are going to be asked like duplicate questions to make sure you know it, like how the discounting works. 210, net 20, net 30. I'm going to ask you to do your closing entries. Like, what is retained earnings? How do you calculate retained earnings? Right, it's our beginning retained earnings plus our net income minus our loss and dividends equals ending retained earnings. And I also asked about your closing entries. We talked about those too. I'm going to ask about the different definitions in the bank reconciliation, right? What are the difference between outstanding checks and checks receivable? I'm going to ask you to calculate gross profit. Gross profit versus net income. Right, and what's the difference? Right, gross profit is our sales minus our cost of goods sold. Our net income includes everything else. Right, so the multi-step income statement. Yeah, you need to know your normal balances. It's going to keep coming back. I drafted this midterm last week after looking at all these lectures. So this should all be stuff we covered in a lot of detail. I was trying to be very relevant, but you need to know your normal balances. You need like the fundamentals. I'm really covering heavy in this, right? Know your accounting equation, know your debits and credits, know how to classify each asset, like your accounts receivable versus your accounts payable being a liability, accounts receivable being a debit. No, dividends are a debit account and that they reduce equity. Right? All the very fundamental pieces I'll be covering a lot. Like what is deferred revenue? Is it a liability or is it equity or is it an asset? What's prepaid rent? Know all of these pieces. We talk about inventory a lot, like FIFO, LIFO. What are the methods of inventory? We have the FIFO method. There's only 4, right? Methods of inventory. Yeah, FIFO, LIFO, weighted average, and specific identification. That's what we talked about. So know those different methods. We also talked about depreciation. If we all remember depreciation. We got over a lot in this class. It's always fun to do these. Depreciation. What assets are depreciable versus non-depreciable? Remember, land is not depreciable, right? Depreciable. And then how do we determine the depreciation? What are the different depreciation methods? How is equity impacted? And what accounts impact equity? Like remember, revenues, expenses, and dividends impact equity. Everything else affects the accounting equation. You got to know your adjusting entries. Again, we're going to go over a few of those. Those are the basic ones, like your deferred rent, how to calculate the adjusting entry after the initial entry. Yep. And no alternative definitions, right? Like revenue increases equity, but we also know the only thing that can increase equity is revenue or shareholders' contributions, like the purchase of stock. I'd say about 30% of your exam, 30 to 40% is just the fundamentals that we've talked about. Like discounting, your debits and credits, your accounting equation, and where everything lands. I made sure that so the first 2 chapters have about 10 questions each on the 50 question, and then the other 30 are pretty even. So you have like just a few bank recs, you have a few inventory questions, but I really want to make sure you understand, like leaving this class, you need to know your debits and credits. If you don't, then you won't succeed in the next class. So discounting the net credit terms, knowing how to read it. Understanding the difference between the statement of cash flows, balance sheet, income statement, retained earnings. We talked about that. Know your perpetual FIFO. I have one question for each of these, like to determine your cost of sales or your cost of good available for sales or your ending inventory. We talked about the order of the financial statements. We talked about bad debt. We're going to talk a little bit about internal controls. And I'm going to talk about some best practices for internal controls, right? Some of the best practices are you want to keep custody over cash. You want to keep that separate from record keeping. You want cash sales should be recorded on a cash register at the time of each sale. Clerks should have access to cash in a cash register and should not have access to the register tape or file, right? The recording should be separate, the segregation of duties, the fraud triangle, making sure that they don't have we're restricting access. An employee with no access to cash receipts should compare the total cash, right? We should have a manager who compares cash at the end. We talked about that cycle a few times. We're going to talk, I want you to calculate that when a note matures. So if I tell you that a 90-day note is issued on April 10th, you got to tell me when it comes due. Like count the days in the month. We just went over that. Accounting equation impact. the definition of cost of sales versus inventory, understanding the matching principle, right? Revenue recognition principle versus matching principle. Revenue is recognized when earned. We match our expenses to the revenues that they create. More bank rec. Yep, weighted average perpetual. That's it. So I know there's a lot here. It might seem like a lot, but I was able to kind of cover all the topics we'd be going over in about 30, 40 minutes. And so if you study all of that, you have 3 hours to go through all those questions.